One of the biggest questions I see online almost every day across all social media is, should I refinance my VA loan today? It's a great question. And the answer is, it really depends. So for a VA interest rate reduction loan, there are three things that have to be met. Number one, your interest rate has to drop by at least 0.5%. Number two, your closing date on the new loan has to be at least 210 days after your first payment was due on your initial loan. And the third thing is that you have to recoup all of the costs via your monthly savings in 36 months. So what that means is this, is if you save $200 a month, 36 months times 200 would be $7,200. As long as your costs are less than $7,200, then it's perfectly legal to do an interest rate reduction loan right now. Now, does that mean it's smart? I don't know, let's talk about that. So I recently had a customer that reached out to me and said, hey, can we look at a refinance? And by the way, I talked to somebody else and here's the offer they gave me. So I looked at the refinance offer that he got from the other lender, and total cost in the loan was $9,500. The lender was giving them a $5,000 lender credit to cover some of them. And so the true costs, and when I talk true costs, I'm talking bank fees, title fees, recording fees, transfer taxes. All of those costs are like true costs. They're fees in the loan. The escrows and prepaid interest and the taxes, those aren't true costs. You're paying those anyway. So you just ignore those. You look at the true costs. So in this case, he was going to have $4,500 of true costs that were going to get wrapped into that loan. I mean, that's okay. He was going to save. He was going to go from 6.5% down to 5.25%, saving $300 a month and recoup the cost. $4,500 divided by 300 is 15 months. So he's going to recoup the cost in 15 months. That's not bad. That's a pretty decent loan. However, I would contend that there is actually a better way of doing this. And the way I would have structured this loan is, and as a matter of fact, the way I did structure this loan was, instead of going all the way to 5.25, we went to 5.75, and I was able to give enough credit to cover all of those fees. And so in this particular instance, this person was going from 6.5 to 5.75, and instead of saving $300 a month, they were going to save $200 a month. But because there's zero fees, the recoup on that was literally 0 months. So no fees getting added into your loan balance isn't going up, and so it's going to be a fantastic loan for this borrower. The reason I think that's a better move than going all the way to 5.25 is because I do believe that interest rates are going to go down in the coming 6, 12, 18 months. What that looks like, I don't know. How fast that happens, I don't know. It could be, maybe it doesn't happen at all. That's one problem here, right? Is when I look over the past month, there's a lot of uncertainty in the world. That, like, my bingo card for last month didn't have the ex-president getting shot at a rally. My bingo card didn't have the current president dropping out of the race. My bingo card did not have us deploying a full squadron of F-22 Raptors to the Middle East, because that place is totally unstable right now. So there are a lot of things that can happen in this world that could throw all of our projections and our guesses and what all the experts think. Those can all get thrown out the window in a matter of seconds. My strategy right now is, how low can I get your loan, your interest rate? How low can I get that without adding fees to your loan? And if there's no fees added to your loan, you got a lower interest rate, you're saving money every month, it literally costs you nothing. And if things go the wrong way, at least you're somewhat protected, right? You got your interest rate down 0.75%, maybe 1%, maybe even more than that. If things go horribly and interest rates start going back up again, you're at least somewhat protected and you have a better deal than you had before. But if things go the way we hope they go and rates do get lower, then guess what? We can do this again with no fees a year from now, 8 months from now, whatever. When the time is right, we can do that again and do it with no fees. I see it all the time. I've seen stuff online where somebody's refinancing a house and they're told, hey, it's free. Well, a refinance, especially an interest rate reduction loan, it's always no money out of pocket. But that doesn't mean it's the right loan, because I've seen some where they're adding $15,000, $20,000, $30,000 of fees into the loan. Well, it's technically legal, I don't think it's the right move. It's not the right move for you. It's not the right move for that loan officer to make. Working with somebody that can do that math and kind of figure out like, okay, and talk to you really, talk to the borrower and say, is this the right thing? Is this the right move today? Here are my options. Here's option one, here's option two. And your choice may be different than what I would choose for myself, but you should at least have those options and be able to talk through the positives and the negatives of each potential option and where those protections are coming from for you. That's the answer to a long answer to a short question. Should you refinance? Maybe, but you at least should talk to somebody about it. And anybody who's in the 6s and 7s right now for a VA loan absolutely should talk to somebody who knows what they're talking about and can lay out some great options for you, because it may not be a bad time.